Hey there, Investing Iguanas! It's your favorite financial analyst, Iggy, back with another exciting video. Today, we're embarking on a thrilling journey into the world of Singapore real estate investment trusts, or as the cool kids call them, S-REITs. Now, I know what you might be thinking. Iggy, aren't REITs just boring old investments for retirees? Well, think again, my friend. The Monetary Authority of Singapore, MAS, has just dropped some game-changing proposals that could make S-REITs the hottest investment opportunity of the year. In this video, I'll be breaking down these proposals and explaining what they could mean for savvy investors like you. We'll explore how these new rules might shake up the S-REIT market and potentially open up a whole new world of investment possibilities. Whether you're a seasoned investor looking to diversify your portfolio or a newbie just dipping your toes into the exciting waters of real estate investing, this video has something for everyone. Are you ready to take your investment portfolio to the next level? Then grab a refreshing drink, sit back, and let's explore how these new rules could make S-REITs even more attractive. Trust me, you don't want to miss out on this. First things first, let's talk about the interest coverage ratio, or ICR. I know it sounds like boring financial jargon, but bear with me because understanding the ICR is crucial for making informed investment decisions. In simple terms, the ICR measures a company's ability to pay off its debt using its earnings. It's like figuring out how many cups of lemonade you need to sell to pay back your rich uncle, plus interest if you borrowed money to start a lemonade stand. Under MAS's new proposals, all S-REITs will need to maintain a minimum interest coverage ratio, or ICR, of 1.5 times. Now, you might be wondering, what exactly does that mean? Well, it's actually pretty simple. The ICR is a financial metric that measures a company's ability to pay its interest expenses using its earnings. In other words, it tells us how many times a company's earnings can cover its interest payments. So when MAS says that S-REITs must have an ICR of at least 1.5 times, it means that their earnings should be at least 50% higher than their interest expenses. While this requirement might seem strict at first glance, it's actually a smart move by MAS to ensure that S-REITs remain financially stable and can weather any potential economic downturns. By maintaining a healthy ICR, S-REITs are less likely to default on their loans, which gives investors like you and me greater peace of mind. It's like having a safety net in place, knowing that the companies we've invested in have a strong financial foundation and can continue to generate steady returns even in challenging times. So, while the ICR might just seem like another boring financial term, it plays a crucial role in protecting our investments and ensuring the long-term success of the S-REIT market. But wait, there's more. MAS is also proposing to increase the aggregate leverage limit to 50%. This means S-REITs can take on more debt to grow their business as long as they keep that ICR in check. It's like giving them a bigger allowance, but also making sure they don't blow it all on candy and comic books. Let's dive into the current state of the Singapore REIT market and see how it's performing. As of July 7, 2024, the FTSE Sreit Index, which tracks the overall performance of REITs listed in Singapore, stands at 630.80 points. Compared to the previous month, this represents a slight decrease of 1.50%. While a dip might seem concerning at first glance, many analysts and market watchers believe that the S-REIT sector is currently trading at levels close to what we saw during the COVID-19 pandemic lows. This could actually present a fantastic opportunity for savvy investors looking to enter the market or expand their REIT holdings. Right now, the average distribution yield for S-REITs hovers around an attractive 6.5%. This means that if you invest in a diversified portfolio of S-REITs, you could potentially earn a steady passive income stream of 6.5% per year, paid out on a quarterly or semi-annual basis. But the good news doesn't stop there. Based on fair book value estimates, which take into account factors like the net asset value of the underlying properties and the REIT's financial health, analysts suggest that S-REITs have a potential upside of 20–30%. In other words, not only can you enjoy a robust yield, but your REIT investments also have room to appreciate in value over time. It's important to note that these proposals are not set in stone yet. There's a public consultation period until August 1st, and if all goes well, we could see these new requirements take effect as early as January 2025. In the meantime, keep an eye on individual S-REITs and how they respond to these potential changes. Look for those that maintain a comfortable ICR and use increased leverage responsibly. As always, remember to do your own research and consult with a financial advisor before making any investment decisions. Consider factors like the S-REIT's financial health, management quality, and growth prospects. In conclusion, Mass's proposed changes to S-REIT leverage requirements could be a game changer for investors. With increased flexibility and financial resilience, S-REITs might just become the star of your investment portfolio. If you found this video insightful and want to stay up to date on the latest investment trends, be sure to smash that like button and subscribe to the Investing Iguana channel. Don't forget to share this video with your friends and leave a comment below with your thoughts on S-REITs. Until next time, stay savvy, stay invested, and stay awesome. Iggy out.